Hi, it's Rick, and today we're breaking down REITs, real estate investment trusts, in simple terms. If you've ever wanted to invest in real estate without becoming a landlord, REITs might be exactly what you're looking for. A REIT, or real estate investment trust, is a company that owns, operates, or finances income producing real estate. Think of things like apartment buildings, shopping centers, office towers, warehouses, hotels, data centers, or even self storage facilities. Here's how it works. A REIT raises money from many investors and uses that money to buy or finance a portfolio of real estate assets. The properties generate income through rent or mortgage payments, and the REIT passes most of that income back to investors as dividends. To qualify as a REIT under US rules, a company has to meet some strict requirements. It generally must invest at least 75% of its assets in real estate and earn at least 75% of its income from rents or sales. Most importantly, it has to distribute at least 90% of its taxable income to shareholders every year in the form of dividends. Because REITs are required to pay out most of their income, they often offer higher dividend yields than many regular stocks. In exchange for doing that, REITs receive favorable tax treatment, which helps more of the cash flow reach you, the investor. There are different types of REITs. Equity REITs own and operate properties directly, collecting rent from tenants. Mortgage REITs, or MREITs, focus on real estate loans, earning income from interest instead of rent. Some REITs specialize in specific sectors like residential housing, healthcare facilities, industrial warehouses, or data centers. Many REITs are publicly traded, which means you can buy and sell their shares on major stock exchanges just like any other stock. There are also non-traded and private REITs, which may be less liquid and come with different risks and fees. So why do investors like REITs? First, they offer an easy way to get exposure to large-scale commercial real estate. You don't have to buy or manage properties yourself. Plus, they can provide regular income through monthly or quarterly dividends. REITs also offer potential long-term growth if the underlying properties and share prices appreciate over time. Third, REITs can help diversify a portfolio because real estate often behaves differently from traditional stocks and bonds. Of course, there are risks. REIT share prices can go up or down with the real estate market, interest rates, and the economy. Higher interest rates can pressure REIT valuations and costs, and sector issues like office vacancies can hurt specific REITs. Remember, dividends are not guaranteed, and like any stock investment, you can lose money. Always do your research. Investing is simple. You can buy shares through your brokerage account just like you'd buy any other stock or ETF. You can invest in individual REITs or in funds and ETFs that hold baskets of REITs for instant diversification. REITs can be a useful tool for investors looking for income and real estate exposure without the hands-on property management. They appeal to long-term investors who are comfortable with market ups and downs and understand that dividends can fluctuate. Imagine you want to own a piece of hundreds of units and warehouses. Instead of buying a building, you buy shares of a REIT. Now, when those properties collect rent and generate income, a portion flows back to you in the form of dividends. This video is for educational purposes only. Always consult with a licensed professional before making any investment decisions. If you found this helpful, join my bootcamp by going to jointhejourneyapp.online bootcamp. I'll see you there.